Good morning and welcome to the latest installment of Austin Associates webinar series. Today's topic is increasing loan portfolio profitability in a slow growth environment. My name is Andy Morgan and I'm a principal at Austin Associates and I'm managing director of our financial management division. Today's presenters will be Jeff Morris, another principal and managing director of our FM division, along with Michael Scheopner, executive vice president and Chief Risk Manager of Landmark National Bank, headquartered in Manhattan, Kansas. Jeff serves as Austin Associates' lead profitability analysis consultant and works heavily with the firm's loan and deposit pricing system clients. Michael is responsible for all aspects of the lending, credit administration, and risk management functions at Landmark, and while a member of its executive management team, the bank's loan portfolio has grown more than $300 million. Just a few housekeeping items before we get started today. During the webinar, all participants will be muted. If you have any questions during the session, feel free to use the question box on your GoToWebinar control panel. We will do our best to respond to questions at the end of today's presentation. If we are running short on time and we aren't able to get to every question, we'll be sure to follow up with you individually after the session is over. All participants' names and corresponding questions will be anonymous to the other webinar participants. If you get disconnected for any reason during today's session, feel free to call Austin Associates at 419-841-8521 and ask for Lisa. She will try her best to help you get reconnected to the session. If you still have trouble connecting, the session will be recorded for distribution via the Austin Associates webpage, both the recorded version of today's webinar along with the presentation slides. Those should be available within a couple hours after the webinar is completed. With that brief introduction, I'm going to turn the table over here to Jeff, and he's going to dive into today's presentation.
Well, welcome again, everyone. Thank you for taking the time out of your busy schedule to join us for today's webinar. Just a couple of points on Austin Associates. I know a lot of our webinar attendees are familiar with our firm, but a few are not. Since 1972, Austin Associates has been providing investment banking and strategic consulting services to the community financial institution. In 1988, we added a financial management division, and that is the area out of which Andy and I both work, and the area out of which the webinar content is coming to you today. We also have recently added insurance and financial services divisions, technology solutions area of the company, and risk management and compliance division to Austin Associates. Those areas are between 3 and 5 years old within Austin Associates and provide services as well to the community financial institution. The risk management area will be offering a webinar in the same series next month. We'll talk about that a little bit more at the end of today's webinar. In the financial management area, our practice areas a little bit more specifically have to do with asset liability management, reporting, and consulting, where we handle net interest margin simulations, earning at risk, and economic value of equity, EVE analysis, and also provide third-party review of in-house ALM models, something that regulators are stressing for more and more community banks today. That area provided a webinar last month on what CFOs should expect in their next regulatory exam from an interest rate risk perspective. If you were not able to be a part of that, you can still view it. It's available to you from Austin Associates' website. But the webinar today is drawing on the financial management practice area expertise in the area of commercial loan pricing and customer and product profitability. We'll be getting into that briefly. A couple of other services that we're now offering in the financial management area have to do with operational efficiency improvement studies, branch rationalization studies, and management dashboards. So with no further ado, Michael, thank you very much for joining us in the webinar today. Perhaps you could tell us a little bit about your bank in general, the markets in which you operate, the makeup of your lending practices, and your loan portfolio.
Okay, thanks, Jeff. I appreciate the invitation to participate today. I think this is probably an outcome of a dialogue that we started late in the first quarter when we were kind of going over our numbers and reviewing those, and so I appreciate the chance to visit a little more today with respect to that. Landmark National Bank is actually it's a Kansas-based bank. It's actually publicly traded. We're traded on the NASDAQ Stock Exchange under the ticker symbol LARK or LARK. And as a result of being publicly traded, a little housekeeping item on our part or on my part before I begin with specific comments, I need to advise those on the call. Some of the information I may be discussing today falls under the guidelines for forward-looking statements as defined by the Securities and Exchange Commission. As part of these guidelines, I must point out that any statements made during this webinar that discuss hopes, beliefs, expectations, or predictions of the future are forward-looking statements, and our actual results could differ materially from those projected. Additional information on these factors is included from time to time in our 10-K and 10-Q filings, which can be obtained by contacting the company or the SEC. I've actually been with Landmark for 16 years. Since that time, when I joined the bank, there were 2 locations, and since that time, through both organic and acquisitive growth, we have expanded our franchise to 17 cities across the state of Kansas with 22 bank locations. We still are located exclusively in the state of Kansas. Some of our acquisitive growth has been somewhat of a niche growth through acquisitions of savings and loan or thrift institutions. Currently, our asset size is in excess of $600 million. We have a very strong capital base, as noted, both straight capital and on a risk-based adjusted basis. With respect to our loan portfolio, right now our total loan portfolio exceeds $300 million. I mentioned the history that we've had in acquisitive growth and organic growth, with the acquisitive growth being thrift in nature. We've had 1 to 4 family loan portfolios that we've acquired. Strategically, what we do is we're very strong in the origination function with respect to 1 to 4 family originations, but we sell all of our product into the secondary market and allow those 1 to 4 family portfolios to erode off of the balance sheet, and then work our best to transition the balance sheet to something that is very commercial bank in nature. So as of I guess the information that you're providing here are our commercial and our agribusiness portfolios total about $220 million of that total portfolio volume. One of the other risk management practices that we work very hard to maintain is a diversification across not only an industry spectrum through the NAICS codes, but also based upon our geography across the state of Kansas to maintain no specific concentrations relative to either industry or specific geography within the state. I mentioned our 1 to 4 family functions, very strong originating function throughout the state of Kansas. That's been a very good thing for us from customer development, but also from an income standpoint. Primarily in the state of Kansas, our agribusiness customers would be mostly located in the western half of the state, and we would see more commercial real estate activity in the central and eastern regions of the state. The state of Kansas is obviously the heartland of America. It's 400 miles wide, 200 miles high, and our franchise map from the western region to the eastern region covers a little over 300 miles. So it is quite a territory from the standpoint of efficiency model, but one of the things that we have done is taken our geography and basically split it into 3 different regions. We have market presidents supervise those individual regions, the western region, the central region, and the eastern region. And then we do provide centralized services and keep those bank locations primarily customer contact focused, and try to create not only some consistency but some efficiency through that structure. So that's a little bit of history on our company.
Well, Michael, thank you very much. That's a great backdrop on the bank and in your markets, in your loan portfolio. Now, the last several years have been pretty tough for the community banking industry, and I'm sure your bank wasn't completely insulated from the negative effects of the Great Recession. What were some of the market-based economic and financial challenges that Landmark National Bank experienced over the past several years?
Well, obviously, our environment in 2012 is much different than it was in 2007 before we entered the economic period that we're in currently. I think probably every banker on the call has worked to try to generate loan volume through that period of time, and you know, that continues to be a big issue, not only for the industry but also for us, obviously. You know, we have had some decrease in loan balances over that cycle. Some of it, to an extent, though, Jeff, is strategic in nature. Our 1 to 4 family portfolio, as I indicated, which would be allocated under the consumer piece of the graph information. We would, you know, obviously that's strategic to allow those to attrition off the balance sheet. Our ag portfolio, our focus primarily has been on production-based versus ag real estate, and balances in that portfolio to an extent are driven by production cycles, and we've had a couple of decent years of production cycles following an extended drought period in the Midwest, and so those balances kind of ebb and flow as just the cyclical production would predict that to be. And then with respect to our commercial portfolio, we have made some conscious risk management decisions as we went back to the 2006-2007 period and determined it was appropriate to limit or reduce our exposure relative to construction and to land debt. And so part of the declining balances in the commercial portfolio are directly attributed to those risk management decisions. And, you know, like I think every or most institutions within the banking industry, we have had some asset quality turmoil. While our loan losses overall have exceeded what our historical level have been, we've been able to manage those and continue to perform profitably. Our losses peaked in 2010 primarily as a result of 2 credit relationships, both involving national credits, one in the ag sector, one in the commercial sector. And on slide 9, you can see that the provision for loan loss in 2010, $5.9 million, was to compensate for those losses. Obviously, the focus in, as you know, the 2008 economic, I think, recession collapse, pick a phrase that you feel appropriate, as those economic issues developed in 2008. Our focus in 2009, 2010, as related to credit risk management, was very much on protecting the asset quality of the company and protecting the interest margin to a great extent during that period. And also, as you know, obviously, as those economic issues continued, loan demand ebbed, particularly in the Midwest, in our geography, and continues to be at a low or somewhat weak level. As the recession came about, obviously rates dropped, and I mentioned the the efforts to protect the interest margin. Those declining loan yields, I think, is something that the industry as a whole has worked both on the asset side, but also on the liability side as an overall asset liability risk or asset liability interest margin protection strategy. And during that period in 2008, 2009, as rates fell and as the yield curve dropped, our bank, as I think a lot of other banks in the industry, worked to protect the pricing on the asset side by imposing a pricing floor. In our geography, we felt that a lower pricing 5% was competitive, and that's the floor that we did our best to implement during and really still have in place at this point, Jeff.
Gotcha. I appreciate you sharing those trends as they affected the bank. These were indeed tough times. How did the bank fare financially through the challenging years, and what are the effects of on your financial results?
Well, our net income over that period, while obviously we weren't immune to the credit quality or the economic pressures, but I'm proud that through the efforts of all of the associates involved in the credit function and the work that they did, that we were able to maintain profitability through that period. I guess from a profit standpoint, I indicated the losses that we incurred in 2010 and the provision level of $5.9 million. Our profitability fell to slightly less than $3 million during that period of time. But we were able to work through the majority of the asset issues that were in front of us, and 2011 allowed us to return to very acceptable profit level. Asset quality ratios which are trending at or above peer levels, and we released our first quarter earnings for 2012, and we were able to report a record quarter for the company in earnings for 2012. Slide 12, Jeff, when we were talking about the information, I thought that the information on slide 12 was pretty telling from the standpoint of the difference in profit levels reported for the company in 2010 versus our profit levels in 2012. And as you look at those things that influence that, obviously, my reference with respect to improved asset quality and a decreased amount in the provision for allowance for loan loss had an impact on profitability. But when you look at those other items, while we had a increase in general loan and deposit fees, and obviously an ongoing focus for everybody in the industry is managing their operating expenses. I think one of the telling things as you look at the decrease in the net interest margin position, while actually, although it's a decrease, I kind of found that to be somewhat encouraging, because I think that is a reflection of the efforts related to margin protection, both on the loan and on the deposit side. Without conscious decisions with respect to loan pricing, et cetera, that could have been a lot worse from that standpoint. So
certainly, if you think back to the degree of loan balances that were lost over that period of time, in combination with the declining loan yields, holding that number as close to neutral as the bank did in that period of time is actually a very good performance. Would you not say?
I'd agree, and it's one that when we look on the comparative basis at our net interest margin position today versus our net interest margin position, just in a pure dollar amount, the difference pre-2008 to 2012 current is pretty nominal, and I think that speaks well to that margin discipline. And that's kind of played out again on slide 13, where you can see the lower loan balances and the decrease in interest income. Really you have to manage the other side of the balance sheet with respect to the liability side, and we've been able to do that through our deposit pricing also.
Do you want to talk for a moment about what happened in 2012 versus 2011?
Yeah, kind of the slide 14 graph that references the changes between 2011 to 2012. Obviously, I'll go back to the SEC disclosure with respect to forward-looking statements. Obviously, banking and profitability isn't a linear science, but when you look at the forecasting based upon the first quarter data, our strength in a 1 to 4 family production portfolio in this low rate environment on the mortgage side of on the mortgage side of our business, you can see strong numbers for 2012. Obviously, continued focus as on the operating expense management and a continued decrease in the provision for allowance for loan loss are contributing factors to the forecasting for 2012. And again, as I go back to those net interest margin detail, again with the weak loan demand and lower loan balances, I'm pleased to see it. I'm pleased to see it at these levels because, again, without that effort, that's something that can sure be a lot worse in this environment. I think that also plays out, really again as you go back to the net interest margin changes between 2011 and 2012. You can see again, almost a equilibrium with respect to managing those deposit interest costs and offsetting that with respect to the decrease in loan interest income primarily as a result of the reduction in volume in our loan portfolio.
So how did the ROE of the bank fare across this time frame, Michael?
Well, obviously as your profits fall and rise, ROE is an impact. The other thing that impacts from equity standpoint is, we have a strong equity position. How much is enough capital? That's a question that we ask internally. I'm not sure in the current regulatory environment or the current economic and operating environment that I think more is probably better. And so we've maintained high capital levels well in excess of what is regulatorily required. But as you can see on slide 16, the trend as we incurred those losses in 2010, ROE fell to slightly below 4% and has rebounded to right at 8% as of year-end 2011, even at the capital levels that we operate on. And through the first quarter, pretty good return on equity demonstrated as of the first quarter.
Great. So, Michael, as I understand it, all these pressures caused the management at Landmark National Bank, including yourself, to decide that you needed to become more disciplined and more consistently analytical about the way you manage the profitability of the commercial and ag portfolios. Can you tell us a little bit about that process within the bank?
Actually, we started investigating pricing or profitability models in 2006, 2007 as loan demand was still fairly solid. We were seeing a lot of pricing pressure with respect to transactional type credits, and we seem to be getting more and more demand on us to, from a pricing standpoint, at price levels that we were at some point, maybe slightly uncomfortable with. And so, a lot of the profitability, I guess, Jeff, as much as anything else, was intuitive in nature. Who are our profitable customers and the right pricing? And so, rather than intuitive, we were looking for something that was a little more tangible from the standpoint of detail. So we went through a process where we identified options that were available in the marketplace and went through a review and a selection or an interview process. And as part of that, we were able to, we selected the Austin system that would, it was what we were determined to employ. So we went through the process, and you and Andy came out and worked with us to customize the model based upon dynamics of our balance sheet and income statement. When we initially rolled out the model in 2007, 2008, I won't say it was ever an optional process. We did go through that, and we started with maybe a little softer rollout than you suggested, and used the model for review as a part of our approval process on larger credits. We developed a target matrix that would allow us some benchmarks to shoot for in an effort to take our current return on equity with respect to the portfolio and have target improvements on that. As we progressed in use of the model, I'd say that it's become a lot less optional and pretty much a requirement on all approval packages, evidence that we're analyzing whether or not we believe that the structure of the credit provides profitable return to the bank on a risk-based adjusted basis. And as a part of that process, the thresholds for what we utilize the model on have would actually, for the most part, on any credit relationship of a couple $100,000, it's the model output is pretty much expected as part of the approval package. And obviously, the reports that we get from Austin on a quarterly basis provide us with an opportunity to continue to monitor and review our profitability levels on a portfolio and a product type basis.
So one of the things that you decided to do is you implemented this loan pricing system, and you were doing that to assist the bank and the individual lenders to implement a more disciplined approach to loan pricing. Was you linked the system to your core loan and deposit system data. Now, were there some things that you discovered that you didn't know before about the actual levels of return of the various components of the loan portfolio that you learned in that whole process? And did you take the actual provision expense by product type into account in doing that process?
Yeah, we did. That's a good point. We did take and utilize the true data with respect to loss history on a product basis, and obviously with the interface to the core, we had live data that we could utilize on. So it was fairly finite on a product and also on a loan size type. And I think there were a couple of things maybe on the different ROEs with respect to product type that were somewhat telling. Obviously there is a embedded fixed cost with every type of product that we originate, whether that be a commercial real estate loan or an agribusiness loan or a single family 1 to 4 family loan or retail consumer loan. And all of those fixed costs are somewhat, while they're fixed, they are, those amounts differ based upon our process, at least internally. So when we looked at our product type ROE, obviously our 1 to 4 family ROE is driven to a great extent by the gain on sale of those loans in the secondary market, and our our ROE on the consumer side is really a function of we have a very small consumer loan presence, and so there is a fixed cost that's just a part of doing business that is part of that portfolio. I think the other thing that really was pointed out as we looked at that information was probably the pricing pressures that we experience in the agribusiness portfolio, particularly as it relates to larger agri borrowers and the competition that we have for pricing for those customers. Obviously that's provided us a different return level than what we see in our commercial or commercial real estate portfolios.
Do you want to make a comment or two about the process of applying loan losses to specific product types and individual customers as used in the system there at the bank?
Well, I think obviously from a return standpoint, I think that's a critical critical component, Jeff. Obviously as losses peaked in 2010, we made those allocations on a product type basis. Even though the graph line goes up a little bit in 2011, our asset quality levels returned, but because of low loan balances, as a loss as a percentage of the product type, it's indicated there. But I think from a in our mind, or in my mind at least, the using live data from the core and then tying out those losses by product type, it really gives us the best feel for the individual portfolios and the individual customer relationships with respect to the return on equity that we're seeing.
Gotcha. My understanding, Michael, is that once you had this information and you recognize that it was, more information than you ever had before and gave you a better picture of the operating dynamics of the loan portfolio within your bank, you still weren't quite satisfied and you wanted to go a little bit deeper. You wanted to understand the returns of individual customers inside the commercial and ag portfolio, attempting to get a handle on the differences in profitability based on loan size. Is that correct?
That'd be correct. One of the things that we looked at was driving down, through the portfolios to the actual customer side and looking at, as we were managing that specific customer transaction, what we could do to improve the profitability of that relationship. And one of the things that we found, because of just the inherent fixed cost of doing business, when we evaluated those customer relationships, if it was a transactional relationship that struggled from a profitability perspective, and transactional from the standpoint of one deal or one piece of the customer's business versus the entire customer relationship, deposit and credit side. And one of the other things that we recognized as we looked at our overall customer relationship model, the obviously the size of the credit drove profitability to an extent. And say you have a $500,000 or $750,000 credit relationship, but it's structured into 4, 5, or 6 notes. Those profitability returns were less than if we looked at the structure and say, maybe let's take all the equipment and amortize it on a blended term in order to enhance the profitability of that relationship just by the function of reducing the number of notes or the number of times that credit had to be touched.
Now, once you had this information, were you able to use it to better direct your lenders in determining what an appropriate level of return was for each product type and each customer relationship size?
Yeah, one of the things, Jeff, that we did with respect to that is, as we evaluated what our current profitability was on the various product types and in the various loan amount buckets, we took that and developed a profitability matrix that allowed us to establish some internal benchmark targets where, as we went through the process of looking at those relationships on a going forward basis, we were able to review whether or not we were improving or deteriorating the profitability of that relationship on a micro customer basis. While it'd be a Pollyanna to think that you hit the targets every time you touch a credit relationship, one of the things that I think we've used as a consistent discipline is taking the customer relationship as it exists prior to the change that is being proposed, and then reviewing if it doesn't meet those profitability matrix targets that we have in place, at least reviewing whether or not the profitability of the relationship is improving or decreasing as a result of the change that's proposed. That's one of those things that, as you look at our progress with respect to portfolio profitability, I think that served us well.
Now, I understand that because your loan pricing system is integrated together with your loan and deposit core data, you are able to monitor the actual level of officer and customer ROE over time. what information do you have available, which you monitor, and which do you monitor most closely, and who's doing that monitoring?
Well, the information we get is provided in a quarterly report, and is broken down on not only a customer by customer basis, but in the individual officer portfolios. And at this point, the review of that detail is pretty much housed at the senior management level. Obviously, one of the things I look for is macro trends with respect to the individual portfolio profitabilities of our commercial banking staff. So that's something that I think every institution may utilize that type of information or feedback differently. We don't have incentive or production-based compensation programs in place, so we really, I guess, in our institution, it's more of a macro review than a micro review. But I think the information would serve each institution differently based upon what their needs might be.
But you are able to track the individual ROEs of each major lending officer over time, and you're tracking that for a trending standpoint on like a 5-quarter basis?
Yeah, I think that's fair, and as the 5-quarter slide kind of depicts there, you can see the profitability changes with respect to the portfolio of individual loan officers. Actually, when I was reviewing the detail prior to the webinar, I drew a line down through the 3rd quarter, and I think if you go back and look at the yield curves on long-term credits or on long-term yields, I think the 5-year kind of cratered in the 3rd quarter. You can see some pricing pressures evident, obviously, in all marketplaces relative to some of the credits that we've been looking at over the last few quarters with those decline in ROE targets.
So as a result of all this effort, have you actually seen a positive impact in the net interest margin of the commercial and ag portfolios?
I don't think there's any question. I mean, that's the investment we made, and I think, again, going back to the pricing floor and doing our best to, on an apples-to-apples basis, each time we touch the relationship where we're improving the profitability of it to the best of our abilities. I think that's been apparent in all of the different portfolios. Obviously, as we've seen our cost of funding change with the yield curve, that's assisted that. But again, it gets back into that. In my mind, it gets back to that discipline of maintaining the floor pricing when we've had the opportunity to do that. And I guess past the graph lines, if you look at slide 25, the real numbers are you see the mid-2011 numbers versus our end of 1st quarter 2012 numbers. While our loan volumes were down slightly in the commercial portfolio, they were off about $3 million. You can see our profit was improved by a little over $350,000 between those two periods. And again, that gets back into each time we touch that relationship, doing our best to see if we can increase or improve the profitability either through the addition of other business that might be at our disposal or through specific structuring as it relates to credit.
Michael, I assume as you tried to implement these changes in your organization, it wasn't always smooth sailing. Did you encounter some resistance and roadblocks along the way? And if so, what were you able to do to overcome those?
Obviously, anytime you implement something that is new or different than what you've been doing, you're going to have some obstacles or some, just a resistance to change. I would say overall it's worked well for our company, and probably continued coaching with understanding what the dynamics underneath the model are telling you, and then just going back again. Every loan officer thinks their customer is profitable, but going through the dynamics and saying, it's profitable on day one if you do this. on day one plus as far as change this variable? Are you improving or deteriorating the profitability based upon our operating model? Creating that understanding has probably been the biggest advantage to us with respect to use of the model. I would say that, and generally maybe, and I hate to use the line in the sand, but generally, to an extent, the line in the sand of saying that the model needs to be incorporated as a part of the approval function, and creating a recognition that senior management is going to pay attention to it has probably helped as much as anything, Jeff.
Okay. Well, that's helpful to know. Would you be kind enough, Michael, to just briefly describe how the bank uses the loan pricing model to risk-based adjust pricing of individual loan relationships?
We have factors built in based upon our credit risk structure. We use an eight classification grade or risk classification basis, and factors are defined inside the model for each of those. And obviously, based upon the the lower risk, the easier it is to take advantage or to meet those profitability matrices that or those profitability targets that we have built into our matrix. And Jeff, I may have you help with some of the dynamics of those, how those slides work between the different.
Sure, I'd be happy to do that, Michael. Within your system, you have most of the new loan applications, most of the loan renewals fall into one of the higher rated grades. What we show is grade 2, 3, or 4, but what you talk about internally is pass level B, pass level C, or pass level D. Your above average credit, your average credit, or your below average credit. That's where most of the loan pricing analysis volume occurs. And if you were to take a customer that has we're using an example here of a $500,000 commercial real estate loan, your floor is 5%. You don't want to violate that floor, but as competitive as the market rate is currently, you're often challenged by competing financial institutions to go below that. Your basic pricing system analysis for that credit would indicate that a pass B, above average credit customer, to earn a 15% ROE, which is your matrix-based target for a loan of that size, should pay 508 basically for their loan. If you were to make that same loan to a customer that has a credit score slightly lower, a pass C, average credit, a manageable credit risk, the loan pricing model tells you that to get a 15% ROE, you need to charge 517. So we're looking at there being about a 9 basis point premium in the rate that a pass C level customer would pay versus a pass B. And then if we look to the next lowest grade, pass D, that customer would pay 527. Now that's assuming that these customers, we're looking at their loan only level of profitability to achieve that 15% ROE. So to summarize that, there's a 9 basis point premium between the price a C level customer would pay versus a B, and about a 19 basis point premium between a B and a D level customer. Now that assumes no deposit.
Yeah, Jeff, and I think that gets back to initially when we started to investigate the use of the model, I referenced that we were getting transactional pressures, and that's evolved to how do we do better than just the transaction? Let's focus on more business to enhance profitability. And I think the next few items is we've tried not to breach our floor or benchmark floor rate. Obviously, in a competitive environment, there are situations where you try to do your best to win the business, and best defense for that is not transaction, but relationship management. We can really see the changes that makes from a pricing standpoint is to enhance that relationship versus just go out and buy the transactional trade.
And maybe if I could just cover that quickly, a past C-level customer, which is probably more the mid-range, you probably see a high volume of those. If that customer has a relationship with the bank that includes a non-interest-bearing checking account deposit, $75,000 average balance long-term over a period of time, same $500,000 commercial real estate loan, you actually do have the opportunity to violate your floor there if you want to take it and compete for that business and try to maintain the loan volume. The model suggests in that case that you could actually price that loan at 483 and have the relationship as a whole still yield a 15% return. So that might be a modest level of relationship. If you have a customer that has a much more expanded relationship, I'm modeling here a $125,000 checking account. You might think of this as maybe a cash management type of arrangement, where they also have $500,000 in money market, as well as an account with the trust department of the bank, where we're paying $6,000 in fees annually. That relationship to yield a 15% ROE on an overall basis could allow the loan to be priced as low as 453. So,
yeah, we don't. Obviously, we do our best not to fall below the floor pricing, but again, it's a different. The model offers a tool to defend it, just from an overall profitability target standpoint.
Great. Well, I think that's pretty much the core of what we wanted to cover in the webinar today. We've talked about how you went through a process of searching for finding a loan pricing model solution that allowed you to implement the type of pricing discipline that your management had determined you wanted to put in place, and maybe it's fair to say that you've taken some time and to an extent struggled with that implementation. Most change processes in organizations do require a little bit of effort, a little bit of overcoming some barriers and some obstacles. But you've seen a positive impact to your net interest margin on the commercial loan portfolio that compensates you many times over for the cost of that effort. And certainly that effort is ongoing and continuing.
I'd say that's a fair statement, Jeff. The pursuit of profits is always ongoing and continuing.
So we have a couple of questions from the audience today. There's one here that's asking if the ROE on a loan is static or if it changes every month. I can take and answer that question. Within the model, basically the cost of funding is assigned to an individual loan inside a customer relationship based on the term of that loan from a fixed rate pricing standpoint at origination, or for adjustable rates, it changes based on reprice frequency. So the basic net interest margin level of profitability on a 5-year commercial real estate loan is going to stay static over that period of time that the loan is, the fixed rate term applies to. Adjustable rate loans change as interest rates in the environment change. You would expect that if that loan or adjustable rate loan has been appropriately structured, that the margin would maintain relative constancy. But that was one question we received. Another question here I'll just read. Seems like 10 basis points is not enough of a differential in rate to justify what is a substantially higher risk credit. 10 basis points based on a 5-year term, so that in aggregate you are actually receiving 50 basis points more over the entire term. The calibration of a loan pricing model is pretty much totally up to management as far as deciding what level of yield premium is required to adequately compensate the bank. And the credit factors that drive that within the system can be adjusted. One bank management might be looking for 10 basis points of yield, another might be looking for 50. That's all just calibration mathematics in the background of the model that can be used to adjust that. As soon as management decides on that, that can be managed and handled from there. Those are all the questions we have for now. Michael, I'd like to thank you very, very much for your participation in the webinar today. Thank you for sharing the experience with all of the webinar participants that you've gone through there. Hopefully that will be very helpful for them in their own thinking about how they want to proceed with trying to respond to the current difficult dynamics in the commercial lending area. So thank you very, very much, Michael, for being on the call with us today.
Well, thank you, Jeff, and I look forward to your help in the future.
All right, with that, I think we're going to end today's session. I'd like, again, to thank Michael and Jeff for presenting today's webinar. Just keep your calendars open. The next webinar in the series from Austin Associates will be Tuesday, June 26th. You can come back and learn how board of directors and CEOs are managing the rising costs of meeting the increasing regulatory burden. It promises to be a doozy, so definitely look for the invites as we send them out over the next month, and look forward to seeing you back here on the 26th of June. Thanks again, everybody, for sitting in on today's webinar. Again, the recorded session as well as the presentation slides will be available for download from the Austin Associates website, austinassociates.com, within the next couple of hours. Give us a little bit of time to get it up there, but it'll be there very shortly. Everybody have a great day, and we'll talk to you later.